A total return swap is a financial contract that lets one party gain exposure to an asset without actually owning it. At its core, a swap is simply an exchange of cash flows between two parties, usually a bank and an investor. The investor gets the full economic benefit of the asset, including any price gains or dividends paid out over time. In return for these gains, the investor pays the bank a set fee, which is often tied to a floating interest rate. Unlike buying the asset directly, a swap requires less upfront capital, but introduces the risk that the bank might default. If the asset earns more than the swap fee, the investor captures the difference as profit, creating a synthetic return. Investors must remember that these are sophisticated contracts that rely entirely on the other party being able to pay. Total return swaps are complex instruments primarily used by institutions. For more basics on how markets function, subscribe to our channel.